Hello everyone and welcome back. In this video, I will give you 3 tests you can do for your own portfolio right now. 3 small exercises to really test your portfolio. If your portfolio is really designed to outperform the market. Because maybe you are watching this video, you will invest in stocks, you are a stock picker, you are building your own portfolio. Do you know if it will have a good performance or not? Do you know if it will generate some alpha in this market? In this video, I will give you 3 things. So you can run this exercise today for your portfolio and maybe you will make some changes. Maybe these 3 exercises will force you to sell some positions, to buy some other positions, to add more to existing positions, etc., etc., etc. It's a position that is really important for this year, given all the uncertainties we have, okay? In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, outperforming the market. And the goal with this YouTube channel is to make you a better investor. So, 3 things. First of all, I have written here your portfolio. Let me put growth rate. Growth rate of global portfolio. I want you to check your portfolio right now and for all your holdings, calculate the growth rate. For revenue, it should be fine. So you can calculate the growth rate for all your companies in your portfolio. Maybe you have a portfolio of 10 stocks, 20 stocks, maybe more, maybe less. You can calculate the growth rate for all your companies in the future. What is the expected growth rate? Either you calculate it because of your understanding of the business, you think the business will grow at this rate, or 2, you can check what the estimates are for this business, what Wall Street thinks the business will grow at. Wall Street may think the business will grow at 10%, etc. Now that you know this, for each of your companies, you can check if it makes sense. You can check if it is coherent with the track record of the company. For example, if the company in the past, you can check the track record. For the past 10 years, they were growing at 4 or 5% per year, and suddenly they expect to grow at 10% per year. It doesn't make sense. You have a clear reacceleration. The best case scenario is your stocks, your companies have grown at, 10% per year in the past, and now they expect to grow at 10% per year. Okay, the track record makes sense. It's coherent to the future of the business. So now that you know this, you can remove the bad apples. And this exercise will force you to avoid the speculative plays that were never growing in the past, when the future is shiny, where the growth rate is declining. And this exercise will force you to only invest in winning companies. For example, you can invest in companies that have grown a lot in the past and they will grow a lot in the future. A good example is what? MasterCard. MasterCard, you look at the past 10 years, they have always grown at more than 10% per year. And in the future, they are expected to grow at more than 10% per year. It makes sense. The only year when MasterCard's revenue went down was 2020, during lockdown. Apart from 2020, you have a growth rate of more than 10% per year. 10, 12, more percent per year. So it makes sense. And this small exercise, the step 1, will force you to understand this and focus on companies that are growing. You check the track record of the company and the future. You want coherence for your portfolio. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. I can tell you, out of all the stocks in your portfolio, for some companies, you will find some funny things. Some companies with declining growth rates, some companies with reacceleration. Every time you have a question mark, you are perplexed. Go deeper. Maybe this stock doesn't deserve your attention. Maybe your stock has to be sold in your portfolio. if you don't know how to estimate the growth rate in the future. As I like to say, you want investing to be extremely simple. Not easy, but simple. If you cannot have a simple DCF, a simple estimation of the future of the company, maybe don't invest in it. For all my holdings, the analysis is pretty straightforward, pretty simple. My valuation tool is pretty simple. You just kind of know what will be the growth rate in the future. And if you don't know what the growth rate of the future will be, maybe that's speculative. Maybe that's just speculation and that's not investing. So that's the first thing. Also, you can check this global growth rate of your global portfolio and you can compare the global growth rate to the S&P 500. What will be the growth rate of the S&P 500 for the revenue? Compare it to yours. Are your companies, the aggregate portfolio of your aggregate companies, growing more than the market? A good question to ask. Do you invest in companies that are growing faster, that are better than the market, or that are slower than the market? Most likely you want to be invested in better companies than the S&P 500. This is why people are doing stock picking. They think they can do better. So normally you want your global growth rate to be higher than the S&P 500. Please check this. What is the revenue growth rate for your companies? Second thing is the pricing power. We live in a world with inflation. We live in a world with uncertainties. You want pricing power for your companies. You can check for all the stocks you have in your portfolio, what is the pricing power of your companies? In other words, what is their ability to raise prices without customers leaving? For example, Apple can raise their prices for the iPhones and people will not care. If my iPhone breaks, I will buy another one tomorrow. If the price is 20% more, I don't care. Okay, this is the kind of pricing power they have. If Ferrari wants to increase their prices by 10%, they can do it, no problem. And they are doing it, by the way. Okay, some companies don't have pricing power. You want your portfolio to be filled with companies with a growth rate and also pricing power, because inflation is here to stay. Now inflation is what? 3, 4%, 5%, depending on the industry. In the real world, maybe it's higher than this. So be extremely careful. You want to be invested in companies that can increase their prices, just in case. What if inflation picks up and we go back to 5-6% inflation growth rate? If you don't have pricing power, you will get murdered in this market. If you have pricing power, you can increase your prices. The iPhone prices can go up a lot. People will not care. The switching costs are just too high. So you can check for the pricing power the gross margins. You want gross margins to be high, depending on the industry, but 50% is a good benchmark. And also you want to check the qualitative pricing power. Pricing power. Some things you can check on earnings calls, something you can check. What is your understanding of the business? Do you know if in the past the business has increased the prices? If so, by how much? If so, what is the retention rate, etc., etc., etc. And if you don't know this, it's the opportunity for you to learn more about your businesses. Okay, some companies you will know a lot about. Some companies you don't know so much. So these exercises will give you the opportunity to review your portfolio and ask the right questions to really understand what is important in investing. And the third exercise is the valuation. Now you can check the valuation. You can do the forward price to free cash flow. That could be decent. Forward price to free cash flow, forward PE ratio of your overall portfolio. If you take into account the weighing, the aggregate valuation of your portfolio, and you compare it with the S&P 500. Is your portfolio more expensive than the overall market? Is your portfolio having the same valuation? Or is your portfolio cheaper than the overall market? The best case scenario is your growth rate is higher, your pricing power is excellent, and the valuation of your portfolio is cheaper than the S&P 500. This is your best case scenario. Now you can do these 3 exercises today, right now, and run your portfolio through this. Do this exercise and let me know, because you will be surprised. Some companies don't have pricing power. Some companies are decelerating or declining. Some companies are extremely expensive, and it will make you ask the right questions. Am I invested in this stock for the right reasons, or is this just speculation? So these were 3 small exercises for your portfolio today to make sure you outperform the market. Because if you have a portfolio that is growing more than the market, that is sustainable and efficient in a world with inflation and with cheap valuation, you increase your chances of outperforming the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.